All right, welcome back, everyone. We're here with two of our wonderful TD mobile mortgage specialists. We got Mario Damjanovic and Jesse Bilodeau from our. I had a moment. I was about to. Well, I had Gurjinder in my head because Gurjinder's not going to be with us today, unfortunately. So we're going to meet Louisa in a second here in the second segment. But Jesse actually, Jesse and her team did our mortgage personally as well and stuff. So we ended up having where. We are TD clients as well, so that's outstanding, and you guys have brought so much value to us. So, and I know that you guys have seen a bunch of Mario's business tips and the stuff that Louisa and Gary have done. Say hi to these people in the office. Stop by. They have so much knowledge, as we're about to demonstrate today. So let's kick it off here. The mortgage rules are changing. There's some misinformation. Take it from the top. Who wants to start?
I guess I'll start. So there's three different changes. Change one is the one that's getting the most attention, but we'll touch on all three because I think the other two kind of aren't talked about a lot. But the first and the main one is the stress test, right? So as of January 1st, there's a new stress test coming only on conventional mortgages, right? So I think some of the misconceptions is just that it's going to be affecting all mortgages. So this change is strictly on conventional mortgages.
Okay,
right?
okay, awesome.
Yeah. So one way to look at it actually is to kind of look at it as an add-on to the initial changes that they made October of 2016. That was kind of the more impactful change. That one we did see some more impact to first-time home buyers. More clients were affected by that change originally.
Right.
So we are seeing this almost like an add-on to that one originally that had happened in October. So
the changes happened, and now they're sort of completing the circle. So let's, there's actually three changes, so take us through exactly what they are.
Yeah, so the first one, the stress test, basically on conventional mortgages. The qualifying rate we're going to need to do our calculations for GDS and TDS, it's going to be the higher of the benchmark rate, which is currently 4.99, or 2% over their actual rate. So for most mortgages, based on what rates are looking at today, it's going to be the 2% over their actual rate.
Right, okay, okay. And then how does that affect a buyer?
Well, for a quick example, your average home price is probably going to be in that higher range of $400,000. So just for easy math, let's assume a client's purchasing a home of $500,000 and they're putting down the 20% to keep it conventional. With 20% down, you're looking at about $100,000 down, which leaves you with a $400,000 mortgage. Visual aids I know are a little bit helpful, but I'm going to go with a pretty easy example here. So let's assume that the contract rate, the actual discounted rate, is at 3.44 on this $400,000 mortgage.
Is that about where rates are today?
That is pretty well where they are. We're actually a little bit lower, but that's just kind of where some of these examples lead to. They're around that 3.45, 3.5 range. We are a touch lower, which is kind of nice to see. But just to keep the math simple, let's assume it's 3.44 with a 25-year amortization. That's fairly standard for qualifications. What it does, it'll actually take your monthly payment from 3.44 being $1,985 per month for the qualifying payment. With the new rules, and assuming that we have to add 2% on to qualify at that 2% premium, it takes the monthly payment to $2,427, which is just shy of $500 more.
Wow.
Or about what would it be, about $450 or so. So it's quite a bit of a jump in the payment. So what does this mean for a client? Essentially what it does, it takes, there's two ways to look at this, two schools of thoughts. It could be a decrease in buying power for the client of about 18% on average. You're seeing things in the news, you're seeing 20%, 25%. It all depends. Yeah. There's all sorts of things coming out. We're seeing on average about 18% from a calculation that I've done personally. That's pretty well on par with what they're saying. Or from another angle, it could mean that the minimum income that's required, instead of being, let's say, $70,000 for the initial 3.44 qualification, we may need to show higher income, which could mean adding a co-signer, adding a spouse, adding a friend, adding somebody, or just being a little more creative on how we show income, which obviously there's creative ways of getting things done at times. But what it does, it takes that $70,000 required income up to $85,000, so about $15K more income. So again, school of thought there is maybe we need to show taxes.
And just clarification though, when they actually get their mortgage, they get the lower rate.
That's right.
So it's not like they're paying more.
Definitely.
They just have to qualify a little bit more.
Right.
That's right.
When we were going through the payments, that's just the qualifying payment we have to use. Their actual payment in reality isn't going to change from their true rate, their actual rate.
Right.
Yeah.
Okay, so there's actually a few other changes too, but you said that this isn't necessarily something that's mandated that the lenders got some options here. What's going on here?
Well, the second change that is kind of being noted out and about in the community is the change to, I guess, enhance the loan-to-value structure. What it is, it's basically, and from what we're able to see, there's not a whole ton of detail, unfortunately, but what they're kind of aiming towards is, I think, trying to cool those hotter markets, mainly targeted towards Toronto, Vancouver, some of those markets that we've seen large increases on. So they're just trying to, I guess, level off the loan-to-value lending requirements for those areas. So instead of maybe being able to lend up to 95% or 80% conventionally, they're going to want to draw some of those down. There is no specific rules, unfortunately, to what they're requesting, but they've basically asked the lenders to assess their existing policies and adjust accordingly to those different locations or areas of the country that may need that adjustment.
And then there's a third change as well that's
There is.
proposed or coming.
Yeah. And just to add a little bit to that second change, it also could do, it's about risk. So anything that's viewed at risk, whether it's like inflated house pricings or maybe certain properties, like let's say a rental could be viewed as higher risk. So there'd be loan to value restrictions on maybe some of those higher risk type of properties, right? And that kind of leads into the third change. So right now, whenever there's a kind of change that's introduced like that, people always find ways to kind of get around the rules, right? So let's say lender A says on this rental, for example, due to risk and due to these new rules, we can only lend 65% or 75% loan to value. And that same client would then maybe go to a secondary lender to get the extra 15 or 10% that they might have wanted.
Right.
Now the third rule is basically saying that's no longer going to be allowed, right? So you're no longer going to, if the rule restricted the lending to 65, you're no longer going to be able to go to a second lender and bring it up to 80 because in a way you're getting around the rule. So
now,
that's going to be taken away.
You have a bunch of scenarios or how this stuff plays out in terms of timing on pre-approvals and things like that. Mario, give me really quick though before we get into that. What's the government's overall intention with this? What's the goal?
I think it just adds on to the initial changes that we had back in October again. So it's just to kind of cool down the housing markets, especially in the areas that need it the most, and to kind of mitigate some of the risk. I did read an article, I'm just trying to think the way they worded it, but it was essentially they want to mitigate their own risk because they're basically insuring and in some cases regulating us, well I guess in many cases regulating us as the lenders. So they just want to make sure that they're regulating accordingly and making sure, because things are a little bit out of hand in certain areas and people are still qualifying, housing markets are still booming, so they're still trying to find ways to just kind of level it off and I think ultimately cool it down, which, I mean, not great for our businesses, but we're always going to find ways to get things done, so it's not a major...
Yeah, and home ownership is going to continue on. In our next segment, we're going to talk about exactly that.
Yeah. There's also, we always kind of look at the negative, but there's a protection aspect there, right? So historically, we've had super low rates for the last few years. Like 2% mortgage interest rates is crazy, right?
Yeah.
Like even 10 years ago, prime rate was over 6%, right? So it's the idea that people in these 2 and 3% mortgages that have maxed out their payments, they can afford their payments, but what happens as, the economy recovers, interest rates goes up, and now when they're due for renewal, it's going to be 4% or 5%. Can those people still afford those payments and not lose their home? So there's a protection aspect to it as well.
Yeah, many people, especially they're putting down 5%, are trying to buy as much as they possibly can, and it's like, well, you might be a bit over leveraged, so sort of saving people from themselves in terms of human nature.
That's right.
Exactly.
Okay, give us some information on. Because one of the questions is, you get somebody approved today, they're not buying to the new year. There's a bunch of different information here. Also, what it affects in terms of, I guess we can talk about refinancing and stuff too. But take us through some of your notes here.
Yeah, so just essentially pre-approvals, right? So basically, we want to see a live deal prior to the change, right? So if you're writing a live offer in 2017, it's still going to be subject to the current rules. If you're writing a live deal come January 1st, we're going to assume that you're going to have to use the new qualifying rules for that live deal.
Got it.
Right?
So they have to buy a house in 2017, or the possession. What about the possession? Because there's issues with that too.
That's right.
And do you want to maybe jump to that now? So it's like, so I wrote a deal December 10th, and possession is February 1st.
Right. So a very important thing to look at is whether or not your lender does firm approvals. TD does, and that's going to be a huge asset going forward in these next few months. So for example, you write a deal in December, but the closing's not till February, March, or however many months into the new year. If your lender's giving you a firm approval and there's going to be no reason to re-adjudicate that file or rewrite that file, that approval is going to be 100% honored. But if you're working with a lender who doesn't give firm approvals, and let's say they give you an approval in 2017, come 2018, if 30 days before close, they're required as a lender to rewrite your file, there could be some risk there for some buyers. So it's very important to look at how your lender does your deal and is it truly a firm approval.
Cool.
Did you want to talk about refinances and renewals?
Yeah, so I guess on the refinance side of it, really we're seeing probably more impact on that side. People that are going to be trying to requalify, they're going to be able to go back up to 85 or 80%, but we find many of those clients also tend to go into a 5-year fixed, try and maximize what they can refinance into. We might see some impact on those fronts, but again, it's not going to impact new purchases in the majority of cases. And as for renewals, kind of goes back to what Jesse was actually saying. Clients that are going to be coming to renew, again, if they don't, well, let's say they qualified originally 2 years ago, they qualified at the lower rate, and now they're coming in to try and requalify, let's say 3 years down the road because their mortgage is renewing. A lot of lenders don't guarantee the renewals. TD, on the other hand, does. So our clients won't be at that risk as long as they're in good standing, but clients that are outside of TD may not be protected from that angle. So we may even see some risk with renewals coming down the road with people that are maybe at a smaller lender, a B-list lender, who doesn't guarantee the renewal. Now they're having to requalify at the new rules. So
I've been through that personally. Haven't I?
I know, I said, I won't bring it up.
I was one of the guys that was qualified as a self-employed individual on a very special mortgage circumstance in 2007 when everyone was handing out money. And then 2010, I had to renew, and my bank said, no problem at all. My property value had dropped from about 410 down to 350, and they said, just requalify. Well, I had no equity in the house. I wasn't claiming much income because I was self-employed. And so I said, well, I can't qualify under your terms. And I said, okay, well, just pay us back that $360,000 you borrowed. And you're just like, oh, okay, that's interesting. I thought a mortgage for 25 years. Turns out a mortgage is actually only the term that you have for it. And that was very interesting. So anyways, got it figured out, obviously. But that's it. Now talk about builders as well.
Right. So builder mortgages, so I do a lot of builder mortgages. I think so does Mario, a lot of people on our team. So they're unique in their own way. So I have a lot of existing builder approvals that I had done throughout the year whose closings are going to be after January. So those clients, if they're not rewriting their mortgage approvals, we're going to honor those firm approvals on those builder deals. But we see a huge percentage of clients who want to add upgrades. So when they're adding upgrades, when we're rewriting their deal to add upgrades, and if we're doing that in 2018, now we're going to have to requalify them to add upgrades under the new rules. If they're not making any changes, paying their upgrades out of pocket, nothing's
This is a huge consideration.
Yeah.
And I wonder if Realtors is bringing value from representing a client at builders. The builder sales representative just might not even be educating themselves on this.
Right. So personally, we're going through all our builder files, and I'm going through, okay, which ones, I only have to go through the conventional ones, right, which is only about 50%, because about 46% of mortgages are actually conventional. So half the builder deals I have, half of them should be conventional, right? And then it's only the clients who might not qualify for their upgrades under the new rules. And if that's the case, then basically I'm getting early adjustment statements from their builders, and we're making sure that we're rewriting those deals in December to avoid any risk to them in January. And again, our builder deals, as long as you're not making changes, are firm. Not every lender does it that way. So again, things that realtors and clients should be looking at right now if they have existing builder deals in the pipe.
Interesting. Final comments on anything that people need to know right now?
I think that covers it for the most part.
Okay, awesome. I want to really, really thank you guys for coming on. Again, Jesse Bilodeau out of our Northwest office, Mario Damjanovic out of our downtown office. Feel free to give either one of them a call for any questions you guys have. Get the facts. Appreciate the fact that TD doing firm approvals on this stuff, because we don't always get the time when our deals close.
That's right.
So thank you guys so much, and we are going to be right back with more of the mobile mortgage specialist team, and we're going to be talking about how we expect it to impact the market. Hey everybody.